Hi, so today I think it's a great idea to look at the big four tech companies because they've now all released their Q2 earnings reports. So that's Apple, Alphabet, Amazon, and Facebook. And there has been so much media coverage around these four companies, so it's really easy to get lost in all of the articles and all of the speculation. They are the most watched companies, and it's rightly so because they make up a large proportion of the overall stock market. So let's see what has happened, and we'll try to decipher what is noise and what is the really important information. So the harsh reality of investing is that 90% of all investors lose money. And I think it's because they're not fully understanding what it is they're actually making an investment in. And I also think if these investors had a more longer term view on the investments that they're making, well, the 90% failure rate would definitely reduce. Anyway, my goal is to help as many people as possible understand what it is they're actually investing in. Because most of these 90%, well, they're making investment decisions with very little research. They are spending more time researching their next holiday than they are their next investment. Oh, and FYI, when I say Google, I really am referring to Alphabet. Alphabet is just the trading name for Google. It isn't important, so just don't get confused, but just more people are more familiar with the word Google than Alphabet. But we're actually going to start with Apple first, so let's go take a look. So here are some of the important numbers from Apple's earnings report. Revenue was $59.7 billion, and that's up 11% from a year ago. And the analysts, well, they were expecting $52.25 billion. And the profit has risen to $2.58 per share, which is up from $2.18 a share a year ago. Now, analysts expected it to be $2.04 per share. Look, you're probably getting sick of me talking about how the analysts get it wrong a lot, and it's all a bit silly, really. I mean, if the company's profit is declining, but not as bad as the analysts think, well, investors are in a good mood. And if profit is big, but not as big as expected, well, the market is now in a bad mood. I'll take the profitable company, so thank you very much. And a lot of people just get spooked by what the analysts think. Apple also announced a 4-to-1 stock split. Now, don't get too worried about this. This is really not that important. Just for every one Apple share that you currently have, you're just going to get 4 in return. So if the stock price was $400 today for one share, well, after the stock split, you're going to get 4 shares for $100 each. I just want you to be aware of this because it doesn't change anything, and I don't want you to freak out when the stock price falls 75% on August 31st. And Tim Cook, the CEO of Apple, had this to say. Apple's record June quarter was driven by double-digit growth in both products and services and growth in each of our geographic segments. In uncertain times, this performance is a testament to the important role our products play in our customers' lives and Apple's relentless innovation. So iPhone revenue was up to $26.42 billion, and that's up from $25.99 billion last year. Mac's revenue was also up to $7.08 billion. iPad's revenue was up to $6.58 billion, wearables was up to $6.45 billion, and the App Store revenue, well, it's $13.6 billion. And all of these areas were significantly up from this time last year. And that's the important point here. So I thought Microsoft had a really good quarter, but Apple, well, they had an amazing quarter. To sum this up in one word, I would have to say it is epic. Literally, every possible area of the business was up a healthy amount from this time last year. And the share price has responded. It is currently sitting at about $425 a share, roughly. And the big question now is, where does the valuation sit with these incredible results? Well, putting the new numbers into my intrinsic value calculator, we get a new price target of $455. Now, this is a big jump from where it was previously at about $325. Oh, and for those who are interested, this is the data that I used. Now, if I wanted a margin of safety, I guess we could use, say, 17%. Now, that's not a strong margin of safety, but it's a really good company, so we probably don't have to be as safe. So maybe we can be a little bit more aggressive and use 17%, and that'll give us a buy price of $250. So as a value investor, well, I think it's just too late for Apple. The good results are already factored into the price. If you were to buy Apple shares, I think you would get around about 10, maybe 12% as a long-term investment. Now, 10 to 12%, well, that's pretty good, but I want more than that. But I would support anyone who was investing in Apple for the long term. They are an amazing company with an amazing brand and they're delivering fantastic results. Now, just on a side note, the biggest shareholder of Apple is actually Berkshire Hathaway. And that's really good news for me because I have a big stake in Berkshire Hathaway. So another way to invest in Apple is actually to invest in Berkshire Hathaway. Now, that is a different strategy and not many people are talking about it. So are you liking these quarterly updates? Don't forget to subscribe if you're a value investor like me. All right, now let's go take a look at Google's earnings. So here are some of the important numbers from the Google earnings report. So earnings came in at $10.13 per share. Now that's down from $14.21 per share a year ago. Now analysts thought it was going to be $8.21. Revenue came in at $38.3 billion, and that's down 1.6% from a year ago. Now analysts thought it was going to be $37 billion. And another thing to add is during the quarter, they bought back $28 billion of their own shares. Now I love share buybacks. It is a great way to increase the value of my investment. It is better in my opinion than dividends, as a dividend I have to pay tax. So as an investor, I'm very pleased with share buybacks. But a decline in both revenue and earnings is not great news. As you can see, the analysts were expecting the decline, so at least they got that right. And as an investor, I was expecting a drop as well. And it was obvious. The money to be spent on advertising wasn't going to be as strong considering the global uncertainty and lots of businesses not operating. So I was listening to the CFO of Google, Ruth Porat, say, "We have seen advertising steadily improve throughout the quarter, but we do believe it is premature to say that we are out of the woods yet." So short term, the profitability of Google is going to be weaker than it was previously because the world is struggling. But there has been no change to Google being the most powerful search engine in the world, and it's what clients and customers all over the world are going to keep using. And YouTube, well, it actually saw its revenue increase, so that's good news for Google investors and for creators like me. And long term, I am still a big believer in Google. When the world recovers, whether that's next year or the year after, Google is going to be in the box seat to explode. So there is no long-term change to my thesis of Google, and I was actually hoping with the poor earnings and revenues coming out, well, I was hoping that there might have been some sort of buying opportunity here, but it doesn't look like it. As you can see, pretty much nothing happened with the share price. The price dropped a tiny little bit, but it's nothing significant. My valuation hasn't changed for Google with a fair price of $1,625. And I plan to keep my shares until the share price goes way past this fair value. Now let's go see what happened with Amazon. Here are some of the important numbers from the Amazon earnings report. Earnings were $10.30 per share, and that's up from $5.22 per share a year ago. Yes, that's a 100% increase. Revenue was up to $88.91 billion in the quarter, and that's up 40% from a year ago. And analysts thought it was going to be $81 billion. Now I'm in a good position to give you a little bit of expert information here. You probably don't know this, but I used to run a successful fitness equipment company and I sold a lot of products on Amazon. Now I sold that company 18 months ago, and since then I've been focusing my full attention on investing. But I'm still in contact with some people who work at Amazon. Now they told me that the current lockdown situation, well, that has significantly advanced them in places like Japan, Europe, and Australia. Now the adoption of Amazon in these regions was going along nicely, but because of what's happened, it has put them far in front of where they thought they would be, by at least a few years. Which all makes sense because people have been forced to stay at home and older people have been forced to try out something like Amazon. Whether it's just groceries or things for the house or fitness equipment, sales on Amazon have exploded. But it's the new customers that they have acquired during this period that is going to be the long-lasting effect. So to say that the future looks bright for Amazon is probably an understatement. There has also been a lot of growth in their cloud computing, which is AWS, and that has grown 29%. And considering the size of AWS, well, 29% is actually a lot of growth. So for those Microsoft investors out there that was hoping that Azure was going to be taking away market share from AWS, well, unfortunately, that's not the case. But the whole segment is growing really fast, so don't be too concerned. So to summarize Amazon's Q2 performance in just one word, well, it's incredible. Now, the current share price of Amazon is around about $3,100 a share. Now, based on these incredible results, I have changed my fair value of Amazon, and now it's $2,865. And that's up from my previous fair value calculation of $2,450. Now, remember, that's with no margin of safety. So I'm not interested in buying Amazon stock. And like Apple, well, the party has well and truly started. We're actually late. But I would support anyone who is invested in Amazon for the long term because they're an amazing company with phenomenal growth rates. Now, last but not least, let's go look at Facebook. So here are some of the important numbers from Facebook's earnings report. Earnings was $1.80 per share, and that's up from 91 cents per share a year ago. Now that's about a 100% increase. And analysts, well, they were expecting $1.39 per share, so a massive beat against the analysts. Revenue came in at $18.69 billion, and that's up 11% from a year ago. Analysts thought $17.4 billion. And another important metric for Facebook is the daily active users, which averaged 1.79 billion in June, which is up 12% from last year. Mark Zuckerberg, CEO of Facebook, had this to say: "This is a strong quarter for us, especially compared to what we expected at the start." Now, addressing the US Congress trying to reduce the power of Facebook as an advertising platform, Zuckerberg had this to say: This would reduce opportunities for small businesses so much that it would probably be felt at a macroeconomic level. Firstly, let me just say that comparing the advertising revenue from Google and Facebook, well, Facebook was fantastic. Google was down, but Facebook was dramatically up. Now, this is all a little bit difficult to explain, but my best attempt to explain it is that because the daily active users is up for Facebook, well, Facebook and Instagram have provided small businesses to stay alive during this crisis. But I actually would have thought something similar for Google. But what I think it comes down to is where people spend time when they're bored. They don't spend it on Google, they spend it on Instagram and Facebook, of course. So more people at home on Facebook and Instagram makes sense, right? And whether you love it or hate it, well, social media, it's definitely here to stay. And I think because of this crisis, there's going to be far more people addicted to social media. So as the world recovers, well, the advertising revenue is going to become even stronger for Facebook. And for all the companies that we've looked at today, the future does look really, really good. And that's why so many people talk about these companies. Now, regarding fair valuation, I have recalculated Facebook's fair value using my intrinsic value calculator to coming in at $318 per share. Previously, it was $300, so it's up a little bit based on these new results. Now, please remember, this is with no margin of safety. And with the current share price at around about $250, well, it still has a little bit of room to go. And just like Apple and Amazon, this is great results for a fantastic company. So here is a quick recap. So Apple had an epic quarter. My fair valuation now is $455. Google had a down quarter. Long-term thesis still remains solid. Amazon had an incredible quarter. My fair value is now at $2,865. And Facebook, well, they had a fantastic quarter too. My fair value is now at $318. Now remember, my fair value isn't the price that I want to buy the stock at. This fair value or intrinsic value is what the stock price should be based on its growth expectations and the money that it's making. So normally this is actually the price that I actually consider selling my position. Because when I buy, I want a big margin of safety just in case something dramatic happens to the company. I can't predict the future and I just don't want something unforeseen derailing my investments. So my advice is to don't rush out and buy any of these companies without analyzing the companies in detail yourself. And if you want a calculator that's going to help you crunch the numbers, well, my free intrinsic value calculator is just in the description below. If you've stayed right to the end, please leave a comment and ask me any question you like. I'll make sure to reply and I will see you in the next video.